Hello friends, happy Sunday. Hope you guys are well. I will wait for Instagram to tap us in. It seems today they want to be tricky. Hello Pierre, nice to see you on. Hello friends. Okay, so tell us where you guys are tapping in from. Let us know if you were trading last week. Hope you had a great trading week. Now Instagram is starting to work for us. Sometimes it likes to be funny when we first start. Don't really know why. All right. So yeah, like I said, let us know where you're tapping in from and let us know if you traded anything this week. Oh, Oklahoma. Good day, friends. Yeah. All right. So this week, we do not have that much on the economic data coming out. Mostly it's going to be focused on jobs. So we have Jolt's job report and we have Challenger. So we have a lot of like job openings reports coming out, which will be great for just generally for us to have more information about what's going on in the labor market. But how much that's going to impact the trajectory of this coming week, I think that there are other issues that are kind of baked into where we're sitting in the markets that can have a greater impact on where we are at. So Friday, if those who are trading consistently, Tuesday, and really the first trading day of the last 3 or 4 weeks, we open with a bit of a gap down, and then we have these kind of power squeezes to the upside. So just these massive trend days. And then the next days, normally Tuesday, Wednesday, Thursday, but last week, since Monday was a holiday, the Wednesday and Thursday, they're more consolidation days, kind of getting everything worked out. Since Friday was end of month, we had at the end of day, we had just massive amount of buying, which is in line with all of the kind of pension and mutual fund purchasing that gave us that massive squeeze to the upside. So I think Donald Trump obviously has somebody in his ranks that knows what is going to kind of squeeze markets. And so oftentimes you'll notice that on days where big upside squeezes are kind of baked in, Donald Trump will come out with news that is bearish for the markets. We've continued with this weird back and forth on tariffs. Is the European Union talking to us? Are they talking fast enough? Do we like what they're saying? Or are we pausing tariffs? Are we, it's all back and forth. And same thing with China. And of course, we had the negative news that came out on the Friday that Donald Trump is not impressed with the forward progress. And of course, then the news about chips. So that did not quell the show that was NVIDIA earnings. They came out, they had great earnings. Some people thought that the way that they came out with their earnings, basically saying that these could have been our returns if the China situation wasn't going on, was, a bit of showboating. But, they said what they needed to say to give their stock that kind of boost. And as always, we always talk about the fact that NVIDIA usually has a run up into the earnings, and then the day after earnings, we start to get, kind of a readjustment in the price. And so we saw that more so than on the day after, on the Thursday, but more so on the Friday, we had an even stronger push down. But truly, I think that was overall just rebalancing. I mean, NVIDIA is at some key levels, really going in to test all-time highs. And with ongoing uncertainty and the continued conversation around China and chips, that it's just the market can only price in so many things at the same time. And so, NVIDIA always has a lot of volatility going into their earnings, and when that volatility collapses, normally you see people start taking their profits if they've made money, especially on their shares. So, or on their calls, so that you don't want to be stuck in calls that are productive and then wait too long and then all the value gets sucked out of them. So this week, I think that probably a key sector that I don't want to say has gone unnoticed, but has only a few stocks have been talked about. And this is something I think is really important, is the nuclear stocks, the nuclear sector. The reality is that China is racing ahead when it comes to the whole AI conversation. And a massive aspect of that is being energy independent. And a lot historically of China's energy is focused on coal. And then they were moving a lot to renewable sources, hydro and wind energy. And now they're trying to move very rapidly into nuclear. And the United States as well, just the amount of energy that is going to be required for the reshoring of manufacturing is super high. A lot of times people, when we talk about manufacturing, we think of factories the way that factories had been in previous years. But in reality, a massive amount of these factories are going to be robotic, and they are going to utilize significant amount of AI technology, programming, and everything that, that maybe we haven't realized yet or we haven't seen yet, like come full on to market, but will definitely, companies that do that kind of robotics and engineering and AI, they will put more resources towards industrial robotics, because obviously it makes sense with where the US is trying to go with this reshoring project. I think it has less to do with actually having more jobs, but more just about being winning in the AI race, making sure that in industrial AI that the United States continues to be on the forefront, because of the fact that China is really outpacing us in a lot of ways. And so nuclear stocks have just done really, really well. There, a lot of people talk about Cameco. We did talk about Cameco last week, CCJ. A lot of people talk about Oklo. I also talk about Oklo. That is a stock that we've been trading, and that has done gangbusters for us. And then Okta has also done really well, even though they did give back some of their massive gains, but we were already being a bit cautious trading at these crazy highs. But a few other companies that are doing really well and are really well positioned to kind of spur us forward in different aspects of nuclear. So not just like the facilities, but whether it's valves or other kind of products that are related to the construction of the nuclear facilities, they are also doing really well. So you'll see a lot of them have already had some squeezes. Now, the thing with things like Okla is that Okla is a newer company, and so it doesn't have enough upside price action to give us like a historical bias or kind of targeted projections beyond just using a Fibonacci extension. And Oklo is at is back at its highs, and it's likely to have a nice retracement going forward. But a couple other companies that you might want to look into would be, and I always say I want to get the ticker symbols right, so I wrote them down, is BWXT or BWX Technologies. They have done really well. They're up around 126 at the moment, but I believe that they still have a lot of room to potentially run, because we've only started the nuclear narrative, and we know that at the moment LNG is the easiest source of energy for the United States, not for China, but nuclear is kind of a panacea for everyone. Countries like France that continue to update their nuclear facilities are utilizing some of these companies. So you want to keep that on your list. So type it in the chat so that you all have it. BWXT, BWX Technologies. And then, of course, we always talk about Oklo, so we don't need to talk about that. But what I would say on Oklo, I would not be necessarily buying shares up here. I would wait for it to make a move back down into the 40s, maybe into 35, and I would be selling puts so that I would just be scaling into new shares on pullbacks. So take some profits here, pat yourself on the back. Oklo has had like a more than 100% return since we've been talking about it on the live streams. So hopefully you guys got in, hopefully you guys got your calls or your calendars or whatever, or even been doing short puts and been able to scale into those strategies. Then Lightbridge research. So Lightbridge, LTBR. So you can put that, you can put that in the chat, LTBR. They're also in the nuclear space. And I also think that I'm looking at, they're $15. They have been moving. They're at all-time highs, similar to Oklo, but they do have a much longer history than Oklo. And so even though they're at all-time highs, they're in a much more natural upward trajectory. So they are kind of zigzagging. Again, here, I mean, it is only, it's okay. It was $15. Now I think that in after hours, it's come down a bit, but it is still a relatively inexpensive stock. So for those who were buying Oklo down at the bottoms when we first talked about it, well, you would have, you would be happy now with your returns. And I think that Lightbridge Corp or Lightbridge Research, that they have a very bright future for them in the nuclear conversation. So the other one is NewScale Power Corporation. A lot of people already know about them. They're not like new to the conversation. They were flat for many years. They were just like stuck around $8 for years and years and years. And then recently, because of the potential for, just energy changes and a refocus on nuclear, they did start to get a lot of volatility. And now they've had a massive squeeze back up to the 31. I would be cautious of buying up here, similar to Oklo, just because the charts look very similar. But, maybe scaling in at a key level, using something like the 20 moving average to be able to get you in at a good price, or using the 20 moving average as a way to scale into shares with short puts. So again, that's SMR, NewScale Power Corporation. And then we talked about Lightbridge, LTBR, BWX Technologies or BWXT, and then Oklo. Those four are doing very well and should continue to outperform. Two energy stocks, which will continue to likely do well just because energy resources are insufficient for the need. That's just what it is. VST and CEG. Those are two companies that we talked about a lot for the last 3 years. We have been buying shares. We've been doing puts. That was something that was in our shares section for a very long time because it has clearly been in just a very clean uptrend. So taking advantage of those moves is great. But of course, VST and CEG have just been like this. So, if you don't own any shares, you kind of have to hold your nose and buy, and then maybe hedge yourself with some short calls or short puts. I wouldn't do short calls just because it is still on an upward trajectory. So you don't want to cut your share, have to cut your shares loose or drag the performance down. But so I would be looking more at things like short puts at levels where I can scale in. Now, short puts often take like a massive amount of margin. And so they often aren't like the correct style of trading for smaller accounts. But the kind of workaround is to put it into a put credit spread and then just really widen out that put credit spread so that that short put is the performing piece, so that if you get tapped, like price does come down to you, you can use that short leg independent of the long leg that's kind of hedging your margin. But of course, you were still making money on the credit if it doesn't come down to you, or giving yourself the opportunity to scale into some really good prices. So that's kind of a sector that I think that, everyone should just be watching. I mean, energy overall has been doing just garbage because oil and gas prices are in the trash can. If you have extra cash on the side and you're like able to cope with like just an underperforming stock, the reality is that like the oil and gas industry, like the oil and gas complex can't just disappear, but they're not shares that are going to perform tomorrow. When you get a kind of bottoming and a correction in the price of oil and gas across the board, LNG, crude oil, all that jazz, when they get out of this like backwardation because of just the dumping of oversupply, some of those stocks can start to not outperform, but perform again. So getting them while they're here at these lows is not the worst thing possible. I want to see, whoops, it's not showing me my XOM chart. So, XOM is rounding out this top, but it has kind of it's been chopping sideways. So it's really held here very, very, very well. One of the good things about Exxon is that they're extremely diversified. So they're no longer only like oil and gas facing. They have a massive renewable energy piece to the conversation. So that's also something to be looking at. And that is something where you could do like a combination of different option strategies because it's an extremely low volatility stock. I don't believe that just selling puts or selling calls works here because you just don't have enough volatility to give you a good bang for your buck. And these move very, very, very slowly. What works very well on something like an ExxonMobil is doing something like a broken wing butterfly where you have a wider credit spread, or doing a back ratio spread. So where you buy a call and then sell two calls, but way further out the money. And then that way, as these stocks take time to kind of come up to you, you're not losing anything on time decay or volatility decay, and you have a very low delta, so you're not losing too much in the waiting game. It's a nice way to kind of play the lotto, but because the fact that you're in this massive rounding pattern, if you were a stage analysis trader, this would be you'd be looking for a distribution. So you'd be looking for this to come back, tap into some kind of like liquidity buying area before making its next leg up, just because it hasn't really been able to get over that 120. But because oil and gas is so dependent on the price of commodities, oftentimes you can get really strong pops in the energy sector outside of the normal kind of technical analysis. So something like a back ratio spread where you buy the call and then sell two calls further out the money, it gives you almost a flat delta, so you don't have a lot of exposure for that kind of position. Chevron, let's see, CVX. Similar, but it is chopping below those support areas. The fact that it hasn't held the support at the 140, it's not rounding. It's kind of like doing this into lows. I would like to see Chevron kind of come back to the 120 before I would start like looking like I want to scale in. It does not have clean supply and demand zones, but it is inside a fractal. And usually that can give you kind of a short kind of pop. And then, but I would like to see it get a little bit lower before taking risk on Chevron, just because those lower highs are much clearer on that. And then my favorite is Duke Energy, and that has just done amazing. We've talked about Duke Energy a lot. They also pay out a really nice dividend. That is a company where, like, for my whole life, I will always be selling puts and trying to accumulate more shares. It's a great company, and they hold their performance really well. Now they are basically at all-time highs. Okay, all-time highs is 124, and they're currently at 117. I would like to, if it's possible for them to come back to the 100. That would be amazing. I don't know if they'll get that far down. Yeah, Duke Energy, so DUK. So in this situation, the fact that it still has been forming higher highs and it's not coming back to retest the lows, it's really only at that 50% of that last demand zone. It can hold here. So you do want to be cautious that you're not kind of like overly waiting for price to do something fantastic and drop 20%, because Duke Energy often doesn't do that. It needs something like a COVID scare to get it to kind of break down. It holds its value quite well. So that's also an energy company that you're never wrong for buying, and every year you will look back and be happy that you bought it. They're just really well managed more than anything. So we talked about nuclear. We talked generally about energy. So, I'm not an energy bull, right? I'm not an oil and gas bull. I'm a nuclear energy bull, but I'm not an oil and gas bull. But I do think that there are some key companies that are holding their levels well. And when you when you move from backwardation to contango, then you can get really strong like impulse moves, and you want to be able to catch those. But you don't want to do it with too much risk. You don't want to be like putting a lot of capital and then it's just sitting there for like weeks and weeks and weeks. That's also a massive drag on your portfolio. The big question everybody has is, where do I think the S&P is going next? Are we going to all-time highs here in the next week or so? We are still overbought, and so we needed a bit of a correction. And of course, coming into the end of month realities, we had a lot of positive flows coming into the end of the month. And my charts are just so marked up. Goodness gracious. I need naked charts. So we were expecting to get a little bit of a rollover. We do have that lower high on the S&P, and we just have these massive wicks now on the top and the bottom side. And we have these two inside bars. I think that, the most natural thing for the S&P to do would be to take out some of that negative gamma that is below us. So I think that, us going down and clearing up that wick that's down closer to the 5,700 area, that makes sense. But of course, we're always fighting the headlines, right? So, all Trump has to do is say that we've figured out tariffs, or we've put the deficit issue to rest or something. He's good at that, putting out headlines that give us a bit of positive energy. But on Friday, as we were squeezing up because of all that end of month flows from pension funds and mutual funds, giving us that end of day squeeze, a lot of long puts were coming into the market. And so it demonstrates that people are nervous about the fact that we are sitting still above a gap on the S&P, and not just on the S&P, but on futures. We have a gap in futures that we have still not closed, and that never happens. Usually gaps are filled immediately in the futures contracts, and then they carry on in their natural movement. The fact that we've left that gap on ES gives me the impression that we have some work to do on the downside. The fact that we have so much put buying coming in means that people are still nervous. Those puts are not so far out the money that they're purely a hedge play. In case there's kind of a catastrophic news event, those puts are within the range of the 5,800, so 5,800, 5,850, even some at 5,875, which means that people are buying them so that they can actually make money on the move down. So if somebody was hedging themselves, first of all, they'd probably get a little bit more duration. They probably would be buying like weeks and weeks and weeks out. In this situation, people are buying shorter term. So whatever it is that they're expecting is going to happen, they're expecting that to happen sooner than later. And the fact that they're getting it closer to the current price means that they're expecting to utilize those as protective puts and not just as kind of last, like just in case hedges. So that kind of gives you a feeling that institutions are expecting some kind of pullback, and in part because we're going to be going in very soon, I guess in a week and a half, we're going to be going into buyback blackout period. So companies that have come out in their earnings and talked about doing stock buybacks, they needed to do it during the earnings season. Once we go into the blackout period, then corporations can no longer do corporate buybacks because that is seen as manipulating the next earnings season. And we are almost into the next earnings season, which just seems crazy. But we only have another, like these ending weeks of the last few earnings releases. Then we go into a couple weeks of blackout, and then we're right back at Q2 earnings. So we will see how that goes. But right now, I think the key thing is that because we're going into that blackout period, a lot of the positive energy we have seen has been a lot relating to buybacks and just end of month energy flows, or the energy from the flows, not of energy stock flows, just to make it not confusing. So I think that at this point, we should get some kind of pullback. The fact that we have what is looking like a double top, but with a lower high, is also more bearish. And the fact that our two doji candles are showing us like lower digestion, lower kind of movement in the price, we are needing to do some kind of work down below. Of course, you can't confirm a double bottom until some kind of protected low has been broken. So technically, I can't say that we are rolling over or that we are changing the trend. We are still overall in very positive market structure. But I do expect that just to keep things balanced, that the likely move would be to clear something up on the downside. Now, if we get into that 5,800 or below the 5,800 and we trigger negative gamma and we trigger broker sales, then we could very quickly go and then close that gap. And then we're looking at the 5,600 area for the next week or so. All we really need is the JOLTS job openings report to come out and give us some kind of problematic issues with labor. But I don't foresee that being like cataclysmic or something. I just think that we could get a very natural kind of grinding or digesting down. If I'm looking at the chart as it is, that's number one. And number two, we have a significant issue. Our bond yields are like up in the sky, but it's not just our bond yields that are problematic, and that's much more problematic like as we go into the conversation about the deficit. But this week we have Japan bond yields. They have their bond auctions, and their bond yields are sky high at the moment. And that is very abnormal for Japan. They usually have yield curve controls to help keep the yield kind of propped up, to keep a base to keep their bond yields regulated, I should say. And at the moment, they have a massive amount of volatility in their bond yields. If their bond auction does not go well, if the bond yield continues to increase, that is going to put pressure on US bond yields, because if bond yields are more attractive in Japan and people feel like they're going to get a better return on their investment with the currency, then especially for Japanese traders, the Japanese bond is going to be much more attractive than the US bond. So that will put pressure on our bond yields if their bond auctions don't go well. So that's something that no one ever pays attention to, because that's never been truly of deep consequence to the United States. But at the juncture that we're in, that is becoming much more important than we have, that's become much more important to our daily macro. So I agree, still a ton of sell side liquidity and invalid market structure below us on the S&P. Yeah, I agree. I can see a nice down move. Now I will say, because we have this massive wick above us, it is possible that we try to squeeze up and tap something at the 59.50 just to kind of take out those upside contracts before coming down. But I think the more natural trajectory is that, we just make a nice move down. How long does the blackout period last? Usually it's about 2 to 3 weeks. So it's just between the ending of this earnings season and the beginning of the next earnings season. So I expect to sell off, but most people do. Maybe the contrarian trade is the place to be. I just wouldn't take that trade. That's also very, very true. Oftentimes when you get these crowded situations where everybody, when you get to all-time highs, everybody's expecting now we're going to get the sell-off. What I probably would have liked to see more of is short calls, because a lot of people like to then short the market against their shares, and that's not the positioning that they took. They took more of a long put position, which means that they don't just have a conviction that it's going to roll over, but that there's going to be some kind of intensity to the move down. Otherwise, you just end up losing a lot of capital if you're waiting for price to just gently roll over. So there may be a bit more in it for the downside. Also, I think because of the fact that the way that the market structure is, even if you just look at the trend line on a daily chart of the S&P, we're actually, even if we came down to the 5,800, we would still be inside, that bullish push. So it could just be that we're buying time off the clock and trying to correct that overbought signal. On the very high time frame, like the weekly and monthly charts, we have a negative flip on the MACD. So for those that don't trade the MACD, you have the two signal lines at the top, and when they're kind of moving upward and positive, that you want to stay in your long position. But when they cross over and start to turn negative, then that's usually kind of an exhaustion signal or even a kind of a reversal signal. When those happen on really high time frame charts, those are usually a really good sign that even if you're not going to get a deep pullback, you are going to get some kind of corrective action. So the fact that that's showed up on those higher time frame charts, I think is important for us to be paying attention to. I don't use the MACD as a normal technical sign for like day-to-day stuff. But if it shows up on like a weekly or a monthly chart, I think that that's at least something to pay attention to. So then to the mega caps, I think that people were really expecting all of those to maybe fall apart, but they have kept their upper trend line going very, very well, except for Apple. Apple's been the only one that has really suffered. Microsoft is overextended. It is up at this kind of, or the origin of the down move, and it's doing a lot of digesting, and it has a lot of price gaps. I would not be buying Microsoft here. I don't think that even with 1 billion contracts that this thing can get a gamma squeeze up to the 480 or to the 500. I think that what we're going to get is some cleanup of this activity. I would like to actually see Microsoft come back to the 430 before making another leg up. I would not like to see Microsoft come into that weekly fair value gap, because it did have just that massive candle on earnings. And the reason is because twice Microsoft has digested inside this 380 to 440 zone. And if that wasn't enough to keep us above that kind of above the range, then we are going to see a retest of the bottom of the range. So if Microsoft can't hold 430, but a move to 430 I think is healthy for the price action. But if it can't hold it there, then I think that you start to see 410 again. And that's not great. I think that people who have been buying shares will feel some type of way. So, the mega cap, yep. Apple has macro and microeconomic issues with China and Trump. Yeah, I think that with Apple, so here's the problem I have with Apple's chart, okay? I'll be perfectly honest with you. Apple went all the way back to the 170. And for those who attend the lives regularly, I said that was a clear area that was responsible for that major up move. And we tapped all the way back into that, and we got a really strong V-shaped recovery from that responsible area. We moved up into the very next supply and demand zone and have now done a double top. Now, we've come back and we're holding that support at the bottom of the kind of M formation. But here's the thing. When an origin move doesn't get you into or towards the highs, you are more likely to liquidate that origin zone. Because it means that buyers at 170 couldn't take us anywhere back near to the previous highs without falling apart. And they barely got to the 210 and then started hesitating and shaving their shares. That is very problematic. The chart of Apple, if nobody told me this was Apple and you just gave me this chart, I would be like, the double top at the 220 is going to force us to retest at least the bottom of that origin move of that previous up move, which means that we will need to go down to 160. And if it sweeps and does not hold that zone, then we start testing something quite a bit lower. So that would have been what I would say if I didn't know that it's Apple. So then that to me means then that's actually what I'm seeing, and I need to not kind of BS myself just because of the fact that it is the name Apple, because a chart is a chart. And if that's what the price action is looking like, I'd have to be cautious. So here am I am I doing anything super exciting with Apple? Not really. I would like to see it pick a direction. and not sit here at the 200. So yeah, maybe y'all disagree, but Microsoft is overbought, but you know what company isn't? Google. Yeah, that's actually a very, very, Google. It is just doing us magic. Magic, magic, magic. I love the Google chart. It's beautiful. So Microsoft is overbought, which I completely agree with. And then Apple is showing weakness, but Google is just doing phenomenal. We've been in Google since it hit that like 145 area. We had what we consider a hidden supply and demand zone, and it came back almost to that 200 moving average. So that was beautiful. It was perfect for short puts, perfect for calendars, perfect for diagonals, because you want to get, long-term, long positions. The fact that Google is back above its monthly uptrend line and its quarterly upward trend line is very, very, very positive for the price action. So yeah, we've been very happy with the performance of our positions. Now, am I repositioning myself? Am I adding something new here at the 170? No. And here's why. Because I think, so I have long positions on, which are hedged positions. So even if it takes time to roll up, I'm okay with that as it's moving towards that 180. But I don't like these like really narrow candles with really high upside wicks. Normally when Google does that, it wants to come back down to the bottom of the trend line. So I think that it's possible for Google to want to visit the 165. If it does visit the 165 and it holds, then you want to be able to get long, because then its next target is going to be 180, 185, clearly. So, yeah, I like those. Apple also dealing with issues with IVES and Open AI partnership. They need to fire Tim Cook. Missed on Apple Car, Apple Intelligence, and Apple Vision Pro. I think that Apple just has a lot of things going on. But the reality is that they have so much cash on hand, they can buy a lot of time. And I think that's basically what they're doing. But for me, I'm not interested at Apple in this charting situation. You can look at all the candles all day, add to, but it means nothing in the grand scheme of things. You saw the double top. Google has been acting great. You see the new chart results with Gemini. Google's been performed amazing for us. So I am not complaining at all. Meta has hit our target. So for us, the big, we had been targeting that 165 area. That was our key kind of target when we got the double bottom on Meta. That just had, perfect squeeze, perfect supply and demand zones, nice, easy price action. Now it's consolidating, but it is just below its upward trend line. Again, I think that, we need to make sure, is this printing a double top? We don't know. It hasn't broken down any protected lows. We are slightly above the 20 moving average, which is at the 223. So Meta could be buying some time off the clock as it starts preparing for its next move into the next earnings season. So I'm not sure what the gamma squeeze is for Meta into the next earnings, which will be June 25th. So that's not far. Wow. No, 23rd July. I was about to say what? The period is ending June 25th. But then Wednesday, the July 23rd. But still, that's only like 6 weeks away. So earnings is upon us soon. Let's see. NVIDIA, we've been playing NVIDIA. It's kind of done everything that we've expected. And here all the volatility has come out. It's had its earnings play. Now it's more of a like wait and see what it's going to do, because Nvidia likes to grind into its earnings, and since its earnings have already come out, it doesn't have that same volatility for the move. The fact that we are back inside a rounding top and we didn't take the opportunity to sweep the highs is not my favorite look. I would have preferred that we came into that range, that we put some kind of like imbalance to like take that range out and then come back into the range, but at the top of the price action. And that we didn't do. We're still just in the range of the price action, but we didn't take out any highs. But can we squeeze to the 150? Certainly. That's not the most likely projection. I think that Nvidia could come back around the 123. And then from the 123, it can give us a nice charting pattern that will then allow us to go back into the top of the range, give us an imbalance to push through that resistance. Tesla's just digesting here. It's all about robo-taxi, right? And it had a massive squeeze into the 380 and 400, which we've been playing, and that calendar and diagonal have been doing great. I think the big story here is like the crypto stuffs. So Bitcoin had obviously the massive move. It had its first bifurcation from the overall risk on market. They had a much stronger move. Money was pouring into Bitcoin, and that was doing obviously very, very well. But then it did not. But the other, first of all, it didn't hold the move. It went back into its consolidation range around the 103, which is fine. But I was surprised by the underperformance from things like Coin and MSTR, even from the miners, Mara, Riot. Those all did really kind of, I mean, they were lackluster. I wasn't like too excited about their activity. So I'm not like desperate about anything in the crypto space right now. I mean, like equities wise. So, it's nice that we came back into that consolidation area of the 103 and that we held, and now we're up at the 105. Is it enough for us to get a turnaround? That I don't know. I don't have a strong conviction on directionality from right here, personally. Uber. So we have been playing Uber. We have loved Uber. So we had a squeeze to the 85. So we were waiting for that drop into the 85. And now we start to have positive gamma again. It is possible that it does go down to the 80. There is still some negative gamma sitting down there at the 80, or really more around the 82. But now we're starting to see new positive gamma come in and potentially set us up for kind of the next move into the highs. Of course, we've already played out that like strong run from earnings, and part of the drag could be relating to the people waiting on what's going to happen with robo-taxi, what the impact will be on the other kind of car technologies like Uber, like Waymo, like Lyft. So we'll see what the impact is, and but Uber has done really, really well and continues to have a lot of positive buying action in the stock. So good question. Let me see, what were the other stocks that we're looking at? I mean, the main thing that, we already talked about nuclear, and that was probably, that for me is like probably one of my, like the best plays right now. They did have their squeeze, so you do want to be cautious, not to buy at the highs, but definitely to be setting yourself up. Either have a key entry level that you're looking for, whether you're using moving averages or using short puts at different supply and demand zones, or short calls. Well, I don't think you'd want short calls. You want short puts because you want to scale into them. The other mega cap we didn't talk about is Amazon. That has had a nice kind of squeeze into a very nice trend line. It had a bit of a move up. I would like to see it now get above the 210 for me to carry on with my bullish conviction on Amazon. But yeah, that the structure overall continues to be constructive. I'm looking. I feel like we missed something from the mega caps. But yeah, so I'm not sure if there's sectors you guys are looking at. The main thing this week, I would say, is you want to be looking for the Japanese bond market to see how that performs and what the kind of fallout will be for our bond market. One of the other key things about bond, not just bond auctions, but bond yields. A lot of people think that the Fed controls all the bond yields. The Fed only controls the front end of the yield curve. So the Fed only really impacts the 5 and the 10-year bond yield. Anything above that, the 20 and the 30, is not really impacted by the federal funds rate. That is directly impacted by supply and demand. So that's one of the reasons why a lot of times people say, oh, the Fed is losing the long end of the curve, but the Fed's tools have no impact that far out the curve. So anything more than 10 years, the Fed funds rate doesn't really have any direct correlation to. So the fact that these bond yields have had massive acceleration means that Trump's going to have to do something to calm them down, just because, he's not, somebody around him, if not him, realize that the big beautiful bill, or whatever it's called, is going to significantly expand spending and embed all the tax cuts. So, the government is going to have to come up with funding from somewhere else. And since the tariffs conversation hasn't really gone as everyone expected, the reality is they're going to have to find other areas of funding, or they significantly need to get bond yields down. So whatever kind of conversations or verbiage or wording or whatever Trump needs to be speaking to calm down bond yields, he needs to be doing that as soon as possible, because we are rolling into the summer and we are going to have to start refinancing significant amounts of debt. Now, some people say that, if we look further out in time, that the AI revolution will help us increase basically, GDP, and that acceleration in GDP will basically minimize the impact of the deficit, because the deficit is only as important as it correlates to your GDP. So if you can get your GDP to really kind of pop up, then your deficit numbers start to be less impactful. Right now, our debt to GDP ratio is around 12, which isn't, it actually isn't really horrifying, but there's still the reality of how you are going to fund the deficit. And so a lot of people are saying that, this move towards manufacturing and AI is going to be, if you look beyond just the next year or 2 years, that going forward, if we can get ahead of the AI manufacturing race and get ahead of the energy race, then we have a lot of potential revenue sources coming in. I think that maybe is too far out looking, and that we have like other things that are impacting us more immediately. And so I think that we have to just take those pieces seriously. But the reality of just the matter of fact is that, the big beautiful bill is now going to the House, and so they will have their vote. We will see what it actually looks like. Hopefully it doesn't actually expand further. And then we have to see how they're going to justify, or how they're going to be able to fund this, not just obviously by increasing the debt ceiling, but what the Treasury is going to do and how they're going to cope with that. I think that Besen is feeling a lot of pressure right now, because the reality is that bond auctions have gone very, very badly. And the Fed has actually been buying some of the bonds because of the fact that not enough people are showing up to the bond auctions, because everybody's expecting this tariffs conundrum to cause a reflation. People are thinking that inflation can go back up to 5 or 7. I don't know that we're going to be seeing anything like that, but if inflation were to go up even to 6%, a bond yield at 5% means that you are losing money, and nobody wants to be in that kind of scenario. So bond yields become less attractive at this price, even with a very, very weakening dollar. So it's just something that we have to see. There's a plumbing issue, and how they're going to resolve it. A lot of people will want to say 1 million things, that it will do this and it will do this, and we're going to have a recession and we're not going to have a recession. And I think that the reality is that just don't get married to your bias. Like, we literally are in an era where headlines are moving so quickly. We learn more information in a week than what our grandparents probably learned in a month of data. And we just have to accept that the data is moving very quickly, and we have a president that likes to move the data. And so he is very engaged in all of this volatility. And so we just have to kind of accept it for what it is, and then continue to try and be the best traders that we can be with the information that we have. But I think that too often people marry biases, and then they end up getting totally kind of hosed in the markets. And you see that a lot of institutional investors miss this entire up move because they were just expecting recession to come like this. And then on the flip side, you now have a lot of institutional investors that are trying to pour into stocks when they're almost back at all-time highs. So this structurally just doesn't make any sense. So, as retail investors, we're actually probably outperforming a lot of institutional traders. And part of the reason is that I think that, we don't, as retail traders, we can be more flexible with our portfolio, and we don't if I'm long Pan W and I'm expecting it to move to 220, and then I start to see something on the chart that's like, okay, this actually isn't really giving me positive upward move vibrations. It's easy for me to make a singular decision and exit the trade. But for institutions, it's not that easy. They get married to their positions and they have to stay in. And more often than not, they have to be long the market. They weren't long from the negative 20%. They're now trying to get long from the flat market of 2025. So, don't be too hard on yourselves. The markets aren't easy. They're moving very quickly. Sentiment is changing very fast. So, you want to stay quick on your feet, but don't marry your biases. We've had 2 negative GDP prints. Are we going into a recession? No other parts of the market are signaling recession. Is it because there's lagging data? Potentially. Is it because now, like, people aren't losing their jobs as quickly as they expected, or people are able to find other jobs, or people are able to find other ways to resource income? I mean, the reality is that, personal income isn't like falling off a cliff. Personal income per hour isn't falling off of a cliff. The key data points that would start to be contracting haven't been showing us aggressive contraction in the labor market or in jobs. Now, of course, there are rumors of rumors. And so, and those things matter. We don't want to ignore them. But, if you were expecting a recession and we already had a 20% drop, you have to, also respect the fact that people's portfolios had 50% return in 2023 and 2024. And even though Trump tried to suck the life out of the retirement soul, we're almost right back to where we were. So, and we're only in June. I mean, we're only 5 months into the year. So all that to say, don't be too overwhelmed by what's going on, and stay quick on your feet. Don't try to marry a very long-term thesis, because things can turn around very quickly these days. You just need Trump to change his position or policy on something relating to tariffs, something relating to China, and, things can make a massive leg down, or they can actually just continue to grind higher. So, be cautious of that, friends. All right, we are at the top of the hour, and I hope you guys have a great trading week. I hope you guys wrote down the stocks that we talked about, and if not, you can always come back and revisit the beginning of the live where we did break down some of those nuclear stocks that I liked. And though it does include Oklo, I think that three of the other trades are probably ones that you might not have heard of. They're not as popular. And yes, the taco thing was kind of hilarious. And I think that he took it really personal, but it is what it is, right? Like, you keep changing. I feel bad for him, because I think he thought everybody was gonna. Why should I feel bad for the president? I think he thought everybody was gonna come clamoring to figure out their tariff situation, and I think the fact that he just attacked everyone all at the same time. He didn't, he didn't expect. So, they say if you put starving rats in a barrel, they'll eat each other. I think that's what he thought was going to happen. And in the end, they kind of ganged up and created a union of non-tariff mixer-uppers. So we have a lot to see what's going to come. I think that with China, that's going to be the most interesting, because China is just the solidarity that they have from their citizens to push back as hard as possible is inspiring in a way. And so I think that, Trump has a lot more to compete with than he expected. Everybody kind of, they didn't give China and the Chinese people the credit that they're due. They're, strong. They're strong people. So anyhow, I hope you guys have a great Sunday, and we will see you guys possibly in the Discord to trade with us. This last week, for those that are interested in the Discord, we had a bang out week. We were long PNW, we were long Google, we were long, we were short Uber to the 84. We had short positions, well, not short, but selling positions on SPX. Those all did very well. Then, we had other trades across. We had so many trades on this week, and all of them did very, very well. It's just, it's kind of, it's amazing. And I hope people made their money and are learning all of the different strategies that we have that we are teaching. And so they're not just only focused on buying calls or buying puts, but using other kind of mixes. You are all very, very welcome. And I hope you guys have a great Sunday and hope to see you all in the Discord. Bye for now, friends.